Apple issuing $6.5 billion in debt offering. They just announced it, and they're going to expire between 2028 and 2061. So it's a 7 to 40 year range of bonds. Now, why are they doing this? They say, and let's pull it up right here. They say it's for normal corporate purposes, general corporate purposes, which includes stock repurchases, dividend payouts, etc. Now, here's the breakdown. $2.3 billion will be paying out 1.4%. That expires in 2028. $1 billion will pay out 1.7%, expires in 2031. $1.8 billion does 2.7% in 2051. And the last one is $1.4 billion, pays out 2.85% for 2061. Now, guys, the longer the bond offering, the higher the rate. Why? Because the longer and longer you go, the more likely there is to be for default. So you have to pay a higher premium. But a 40-year bond at 2.85%, that's incredible. They're borrowing at 2.85%. Now, let's go use our software. And for those who have our software, please join along here. So I'm going to log in real quick. So check it out with our software. Let's go in here. If you have our software, please follow along. Let's pull up Apple. Now, $6.5 billion. The first thing I want to talk about is let's go to their balance sheet and see what they actually need. Guys, right here on this balance sheet, they have $118 billion in cash. Okay, total liabilities. They have long-term liabilities, $155 billion, with total liabilities of $283, including their current liabilities. So guys, my initial reaction is, why? Literally, why are they doing this? They are flush in cash. So the big rumor, the big thing being written about is that they're going to buy back shares. So you here on our channel, we love when companies buy back shares. But every so often, I'll remind everybody, I don't want expensive companies buying back their shares. When they use their cash to buy back their own shares that may be expensive, they are investing in themselves at a really poor rate of return. That's what I want everybody to remember. When a company uses this cash to buy any shares of any company, including their own, you want to make sure they're buying shares in an undervalued business. Especially very undervalued businesses, we want them buying their shares back. Okay, this is a common misconception in our share buyback. I am okay with a company that is massively overpriced, issuing shares instead of taking on debt. Now, when I say I'm okay with it, within reason, everything in the investing world is within reason. Remember, Warren Buffett always says that a bubble is created and starts from a very logical and good idea. Owning a home is good. All of a sudden, everybody thinks you must own a home at any price possible. Owning stocks are good. And then it becomes a bubble because people just buy any stock at any price without understanding what they're buying. Same thing with buying back shares. Buying back shares are good if you're buying it at an appropriate price. So is Apple being bought at an appropriate price? Let's go look at its 8 pillars first. Now, we all know that Warren Buffett's been a buyer of Apple lately, but he's even said when the Apple stock has been over, he won't disclose what level it's at. I am quite confident that Apple at 162, he's probably not buying those shares. When it started to fall further, closer to 140 or below, he was buying shares. If you go look at his 13F and all the other reportings, you'll see something around those. And I don't know exactly what his line is, but it's somewhere around there. Okay, so on our 8 pillars, as you can see right here, let me make it a little bit bigger. We have all green check marks except for the 2 valuation metrics, their 5-year PE and their 5-year price to free cash flow. Both are high. Now, does a high multiple of these mean that the stock is overpriced? Well, if the moat's really high, which I would believe Apple's moat's very big, and or they have a really high potential growth rate, I'd be okay with this. But guys, how much can Apple possibly grow from here? Are they going to have the growth rate that justifies 38 and 35 times earnings and free cash flow? Is that really going to happen? Next thing, they're buying back a lot of shares in the last 5 years. Shares outstanding for the last 5 years are down 22%. Now, the clear indication of why this is they have so much cash. And it's really hard to make substantial investments and acquisitions when you have so much cash. Their dividend is actually pretty low. Look at this dividend, 0.6%. So one thing is when they buy back these shares, they're automatically giving themselves a 0.6% yield on their money by buying back shares and not to pay that 0.6% anymore. So let's say they're borrowing for 40 years at 2.85. Boom, off the dribble. If they buy it back all day one today, they say they're basically only paying 2.25% because they're saving that dividend yield. So you got to remember that also when you look at the interest rates. They're saving this dividend yield. And this dividend yield is likely going to increase over time. Not only just in terms of the Apple stock going down, the dividend yield going up, as they make more and more cash flow, they're probably going to pay out a higher portion of their revenue and profit and free cash flow in dividends. But again, let's go back to, is Apple fairly priced? Okay, so let's use our stock analyzer tool. So if you're new to this channel, I'm Paul. I'm a value investor. What I like to do is I like to look at investments as a present value of all future cash flow. But also, I look at my downside risk. I believe the more you learn, the less you fear. When I didn't understand that I was buying a company 20 years ago and I only believed in hype, when stocks went down, I didn't understand it, so I feared it. Now, I do not fear stocks going down. I embrace it. In fact, I love it. So if this makes sense to you, please subscribe to the channel, listen more in this video, and you'll learn more about how I value companies. This is our software behind us. I encourage you to watch several videos to see how the software can help you out in the future. So, stock analyzer tool. Guys, we have a 10-year analysis on stock analyzer tool. You can do 1 to 20. Now, here's our revenue growth rate for Apple. This is the 1, 5, and 10-year numbers. Now, you might sit here and look at it and say, Paul, they did 9.6% a year for the last 10 years. Guys, I'm not going to lie to you. 10 years ago, I would have never thought they'd do 9.6% a year in revenue growth. They were already huge 10 years ago. I would have never thought they'd grow that much. Now, does that mean that they will grow that much in the next 10 years? I highly doubt it. Is that for sure? Well, 9.6% a year for the next 10 years would more than double their revenue over the next 10 years. Well, more than double. Is that possible? Sure. Is it probable? I don't think so. And my goal as an investor is to make reasonable and conservative assumptions and buy when the price is below some of those assumptions. So I'm going to put in 3, 6, and 9%. Let's say they're able to get 9% because the world becomes more technology driven. They rely on Apple more, which is still a possibility. And they're going to have other revenue streams. The rumors are coming out with monthly revenue streams to upgrade your phone, etc. So that's completely possible. Now, profit margin. In the last 10 years, they've done 22.8. In the last 5 years, they've done 23.3, and 1 year ago, they did 26.4. I'm basically going to ignore that 1 year big number. So they're around 23 or 20 to 24%. So again, I want to be conservative. So I'm going to go 21, 22.5, and let's say they really are able to grow their revenue 9% and get high margin business in there. Let's go 24. Free cash flow margin, I'm going to go 24, 25.5, and 27. Now, PE, I'm going to go 14, 16, 18. Now, you might sit there and say, Paul, geez, oh, Pete, what are you talking about? They're 26 and 25. For those of you who are new to investing, I think in the next 5 years, you're going to realize how high that number really is. That's a really high number. In decades past, those are the kind of numbers that got companies sold off and in bubble territory. Now, in recent bull market, we've seen 80, 90, 100 plus PE, so we feel like 25 isn't a big deal. I think 25 is a big deal. Now, can it be justified if the stock price drops big time and the PE goes up because of buyback of shares? Maybe. Or PE stays at 18 because you're buying back shares? Maybe. Because they have a high return on invested capital here at Apple. But again, I'm going to call it 14, 16, and 18. And finally, I'm going to do a 12.5% return. Now, guys, before I hit the analyze button, I want everybody to remember, I've done Apple so many times in the last 2 years, and these numbers change all the time. This is a very well-known idea in the world of science of go off the cuff, go see where everything falls. My goal is to see if it's an obvious buy or not. If it's an obvious buy, I won't buy it. I will go make sure this is done properly. But if it's not an obvious buy, if this is 3, 4, or 5, this is 6, 7, or 8, it's probably not going to make much of a difference. I'm looking for real extreme outliers. I want to make sure that, hey, if this number comes up at, let's say the stock is at 161, this middle number comes in at 140, okay, let me go take a look. Because even if this is 140 versus 130 or whatever it is, I have to sit there and figure things out like that. Okay, I'm at the analyze button. And I also encourage you that if you want to understand the stock analyzer tool more, when you're done with the video, rewind it and check out the stock analyzer tool over and over until you understand how to put your examples in there. So hit the analyze button. That's what we got. We got a low of 60 to 70, a high of 120 to 140, and a middle range of 85 to 100, 96. So if you have our software, put a watch list somewhere here. That way it can notify you. Thanks very much. Watch our next video.